Hi, everybody. Thomas here. I've gotten some questions from people asking me to demonstrate how to roll a covered call trade or a put selling trade. I'm going to go ahead and do that in my rollover IRA account, which you can see here. Before we dive in, I'd like to ask you to help me grow my channel by liking this video and subscribing to my channel so you can get notified every time I publish new content. I also have my Rebel Income Patreon page. I publish daily, exclusive access content on this page, from stock reports detailing my analysis in search for the trades I publish for my trade alerts, to lists of underpriced dividend-paying stocks, and even weekly recordings discussing current open trading positions, as well as current market conditions. You'll find the link in the description area of this video. Take a look. You can sign up for a free 7-day trial of any of my patron levels. I know you'll find something you'll be able to use in your own trades. I have two positions in this account right now, one in Key Corp and another in VF Corp, and I have a covered call trade set on both of these stocks. I bought Key Corp back in December at around $14.55 per share, and I've been able to work with this one on a couple of different occasions and sell multiple covered calls on this. And the call option that I have for this one is set to expire in 1 day. The stock is 70 cents above the strike price of the call that I sold, so it looks like I'm going to be called out of that position as of tomorrow. And that's okay. That's something that I'm comfortable doing. So I'm going to go ahead and focus on VF Corp. Now, I bought this one at about $15.85 per share. The stock is a little bit below that point, so I'm a little bit underwater on the stock position, but I've also been able to work with a couple of different covered calls on this one. The most recent is a call that is set to expire next week. I sold the $16 strike price. The stock is not quite up to that level yet, but notice that when I sold this covered call, I brought in 32 cents per share. And as of right now, the last price on this call option was about 14 cents per share. If you're trying to decide if the time is right to roll an option that you've sold, whether a covered call or a put sell, a good rule of thumb to use is the 50% mark. If you are still a little bit of ways away from expiration and the value of that option has dropped by 50% or more, it's a good time to start considering rolling the option and seeing what alternatives there are for you to continue to generate income on that stock. The trading interface I'm working with right now is Fidelity Investments. So to be clear, the interface you may be looking at is maybe a little bit different depending on the brokerage that you're using. One of the reasons that I like Fidelity for this kind of a trade is because they have a specific function that is set up for rolling. I'll go ahead and click on the call option here, and we can see I get a few different options. Buy to close. Since I sold to open, that would be what I would want to do if I were simply going to buy the option back and close the potential of being called out. But the other option that I like here is this roll option, and that's what I'm going to try to work with. This will give me some different functions to work with. We can see a summary of this position, and so far I'm up about 56% from where the option was at when I sold it at 32 cents. And so I'm over that 50% mark, meaning it's a reasonable time to evaluate the possibility. I'll go ahead and click on roll, and we can see the first line gives me the functions to work with the option that I have already sold to decide what I want those to be. So I'm going to buy to close. This is the number of contracts that I have in this particular case. Now, if I click on more, then I can see what the general range is in terms of the activity for the day. Current bid is 14 cents. Current ask is 15. There's been a pretty healthy amount of volume on this. Once this position has been closed, the buy to close action has taken place. I'm in a position to decide the rolling action I want to take. So selling to open, again, we're talking about selling a covered call. Going to work with the same number of contracts. The next task is to choose an expiration. Now, the option that I have is the April 5th expiration. So I need to be looking in general for an expiration that is usually at least 1 week after, depending on what the price of the stock is doing. In this case, the stock is a little bit below the price that I bought it at, so I'm going to be looking for going out a week, possibly 2 weeks in time. Let's go ahead and go to 2 weeks just for the sake of argument. I'll select the April 19th, 2024 call, and I'm going to work with the same strike price, 16, that I set before. Not necessarily because I have to. That's a price that's a little bit above the price that I paid for the stock, so it builds in a little bit of capital appreciation. With the stock about 60 cents away from that price anyway, it'll be a good way to see what is available above the price that I paid for the stock. Now this is showing me the bid price for this option is 40 cents. The ask price is 43. The other thing I like about what Fidelity does is that they show you the midpoint between the bid and the ask, especially if the bid and the ask is wider than 5 to 10 cents. This can be a quick glance way to evaluate where that midpoint is. If I click more, I'll get more details about the contract the same way I did about the option that I've already sold. Now, this third line is where I can set what I want the overall result to be. And the area that I've circled here is showing me what the different options are. If I simply take the current bid and ask prices for both contracts, then my overall net bid would be 25 cents. If I want to try to maximize that, this is suggesting that I could ask for 29 cents. If I want to split the difference, I can go with 27 cents. I like to work with the midpoint in a lot of cases, just because this is showing me where the market is going to be likely to be willing to come to me within a reasonable period of time. So I want a net credit, and when I click in the net amount area, I can select whether I want the net bid, the midpoint, or the net ask. I'm going to go ahead and select midpoint. Trade type is cash. Now it's showing me what the overall estimated credit will be, 26.35. This doesn't sound like a whole lot because we're talking about just one single contract, of course, but I want to put this in perspective. Remember, I paid $15.85 for this stock. So if I take 0.2635 divided by 15.85, that means that the overall premium that I'm going to be generating here is about 1.66%. If I let this trade go all the way through to expiration and I don't get called out, if the stock is below this point, then the overall premium that I'm bringing in as a result of buying back the call option that I've already sold and then selling out another 2 weeks in time out to April 19th, and I generated an extra 1.66% return on that position. That's for 2 weeks of time. Now, if you think about that on an annualized basis per month, that's a little over 3% just by taking that rolling action. I'll go ahead and click on preview order and go ahead and place it. Get an indication the order was received. And also very quickly, this is one of the things, again, that I like about going with that midpoint, is we can see that this was filled almost immediately. I'll go back to viewing my positions, and we can see the new call option is now showing in my position list instead of the April 5th expiration. Thanks, everybody. I hope this has been useful. Talk to you again soon.